Hi, this is Jeff Camarda. Merry Christmas and Happy Hanukkah. Welcome to our very first video Chairman's Communique. I sure hope you like it. Here's my take on what the election results mean for the markets. While nearly everyone who can has had time to get used to the idea, it goes without saying that Donald's election to the presidency was a sea change shocker, singular in recent memory, an off-the-Richter-scale tumbler that sent a tsunami of change across virtually everything that matters in the political, economic, and financial worlds. However you may feel about this, there's no denying that the markets are moved, and they're moving. The gush of animal spirits springing from the election have driven an ancient bull market to frenzied new highs, with prognosticators far and wide forecasting blue skies ahead for as far as the eye can see. And well they might. In a flash, a finally healed economy's got a shot of steroids, enough stimulative medicine to really start to rock. Consider, tax rates are virtually certain to come down, freeing billions for consumers to spend and companies to invest in new growth. One effect should be for U.S. companies to bring many billions in offshore profits back home once a tax on them is reset to more palatable levels, driving investments in the U.S. economy. Tonic, too, is the promise for sharply reduced regulation, sure to grease the skids of commerce and growth. Add the magic elixir of fiscal stimulus, the promised massive investment in infrastructure like roads and airports, the military, and even, by gosh, maybe even a wall, and the news tips to almost too good to be true. Almost too good, but not quite, for the market and even this humble commentator believe all of this to be quite true and quite good for the economy and the market as a whole. Of course, things don't go straight up, and neither will this rally. The market is still rather pricey at a trailing PE for the S&P 500 of pushing 25, meaning stocks are trading at about 25 times last year's profits, which is no great bargain level. While the Trump factor should drive corporate earnings higher and PEs lower, I do think the market's overdue for a pause. Investors and the media have gotten a bit too giddy about the record highs made and new highs to come, and that's never a good sign. Interest rates are clearly rising, often a headwind for stocks, and another concern is that the markets are operating under the assumption that the full package of campaign promises will be implemented, which is far from certain, as practical matters like crises, time constraints, special interest, world events, and congressional opposition will likely intervene. Remember, the market tends to overreact to both positive and negative forces, temporarily overshooting in both directions, then correcting as reality sinks in. As Barron's aptly put this point to the age of the Donald, nothing has changed yet. My hunch is we'll see a sharp correction come January as investors take profits in anticipation of lower capital gains tax rates effective for 2017. For those with cash to invest, my counsel is to keep your powder dry a bit longer. I think we'll see much better prices soon and better buying opportunities just around the corner. And yes, I do think it's worth buying into this new bull. The Trump card indeed represents a brand new deal for investors, and I think this will propel the current bull market, already one of the longest in history, up for much longer than even I had predicted back in 2009, back when I was a pretty lonesome bull. For now, the long-term view has turned truly sunny, far as these old eyes can see, and my predictions are for a powerful worldwide bull market lasting at least several years now, led by the reinvigorated U.S. stock markets. Interest rates will begin rising relatively quickly in the U.S., driving inflation, so if you need to borrow or refinance, please do it soon and lock in fixed rates. Because U.S. rates will rise faster than those in other countries, the dollar will continue to soar, making non-U.S. stocks even more of a bargain. Above all, brace yourselves for some bumps in market values and try not to look at stock prices every day or even every month. Doing so tends to ring investors' emotional bells in pretty bad ways and prompt decisions that work against their interests. Instead, remember the benefits of broad diversification, such as using the Camarda Ames Plus portfolios, now fortified by DFA funds. These programs rely on Nobel Prize-winning theories that predict higher long-term returns with less risk of loss. No, they don't beat the market every year, but remember, indices like the S&P 500 are in reality only a tiny piece of the actual total stock market, and that other pieces frequently beat the S&P 500. Instead, diversification is intended to get you where you need to go with less stress, less risk, and less potential damage. But for it to work for you, you have to let it, and that means not obsess about short-term fluctuations that can induce knee-jerk reactions and make for bad decisions. When you look at long-term stock charts, such swings, up or down, are revealed for the noise and the gentle upward trend that they really are. Don't dwell on the noise. Try to take this view as I do with my own money. You should sleep better and probably wind up richer in the end. Happy and blessed holidays to each of you, the best of the holiday season. Season's greetings indeed, and peaceful and prosperous New Year. Thanks for watching. I'm Jeff Camarda.